We will now look at the implication of business and financial risks in capital structure. Typically, companies would follow a sequence wherein high-risk projects follow low-risk projects, right? Now, the business risk we discussed was measured or expressed as operating leverage. It is assessed by the level of fixed costs in the business relative to contribution. And one of the ways to measure operating leverage is OL equals to contribution divided by EBIT, earnings before interest and taxes. Hospitals are generally high business risk scenarios because the proportion of fixed costs in the total cost structure is generally way higher than most services industries. You then have the financial risk, and financial risk is expressed as financial leverage or FL, and this assesses the level of debt in the overall capital structure. And one way to measure this is FL or financial leverage equals EBIT, which is earnings before interest and tax, divided by EBT, which is earnings before taxes. So, the total risk in a hospital or an enterprise can be measured as the business risk measured by OL multiplied by the financial risk measured by FL. So the total risk is OL multiplied by FL, which basically will be contribution divided by EBT. The operating leverage, which measures the sensitivity of operating income, that is EBIT, to changes in sales, while financial leverage assesses the impact of interest expenses on earnings. And the combined effect of this is often referred to as the combined leverage. And this combined leverage of business and financial leverage indicates how changes in sales will affect EPS or earnings per share. And this has a direct implication for the management of the expectations of investors, because this investors, shareholders are generally very intolerant of underperformance, and therefore this has to be carefully managed so that the investment decisions will be in tune with their expectations. And this in turn determines the credibility and reputation that the management or the board has in delivering upon its promises. This leads us to the discussion of an optimal capital structure, which, as I said earlier, is the perfect possible mix of debt and equity that helps in maximizing the value of a company in the market while at the same time minimizing its cost of capital. So, a capital structure, as we know, can vary by industry. So for a company that's involved in mining or petroleum or oil extraction, a high debt ratio is not suitable. But some industries, as I mentioned earlier, like insurance, can tolerate a high amount of debt as part of their capital structure. So it all depends on the assessment of the business risk, which means if the business risk, that is, the operating leverage, is high, which means the reward ratios are high as the profitability is sensitive to volume, more equity can be tolerated. However, more debt can be tolerated for project that has lower overall business risk profiles. We must also remember that equity is the costliest form of financing, because investors who put their equity in would demand a CAGR of close to 20 to 25% sometimes over a 5 or 7 year horizon. The higher perceived risk also of a new project, of a greenfield project, is because the risk perceived is high. Generally, greenfield projects demand a higher internal rate of return than brownfield or existing projects that have a positive cash flow or a positive EBITDA. Should also remember that debt has maturities that range from 5 to 10 years or maybe 15 years, and it is very important to synchronize the cash flows in the capital structure with the cash flow signature of the project cash flows so you don't get into stress. Debt can have covenants which have to be carefully considered with respect to liquidity, with respect to security and serviceability. And finally, ignorance of working capital causes immense stress. And I have seen working capital management being often ignored, and we are going to look next into working capital, which I call the orphan child of capital structure. On to working capital next.